Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week was an interesting week with regards to the inflation print coming in as expected. Um, However, markets kind of reacted a little bit differently than I think what many investors might have expected as inflation came down, to its lowest level we've seen in a few years. As of Friday, what we basically saw was a intraday all-time high. But as of the close on Friday, we basically closed on the lows of the week. This week, so far, not seeing a lot of follow through here in terms of a continuation higher here in terms of equities. We have seen momentum start to turn down here. So basically, as we made a new higher high in price, momentum no longer confirmed those new higher highs on the S&P 500, showing some levels again of further exhaustion here in what we've seen from equities. We see the same thing here in terms of the Nasdaq 100, mostly trading sideways here, and the Nasdaq 100 losing some relative performance relative to the S&P 500. But same thing, basically intraday, we made a new all-time high on Friday, but very quickly traded lower from that, and momentum has diverged from those new highs on the Nasdaq 100. So overall, what we continue to see here from equities is the fact that as we make new all-time highs, we're not particularly um, we're not particularly in a position where they are looking very strong. There's definitely some signs of exhaustion here to the upside. We've talked about the fact that over the past few weeks, there's been a very acute lack of participation in terms of the markets moving higher here. And we really have seen that continue here last week. We really thought that this thing was trying to um, really trying to look at um, the sector rotation here this week, and they haven't really improved as a result of that. So we'll continue to monitor markets and kind of see how they are playing out because, at the end of last week, we started to see some participation here. We saw small caps rise on Friday as the micro cap stocks sold off. But yesterday, we started to see that reverse here again. So really are not seeing much participation from small caps. We're not seeing participation from the equal weight S&P 500 indices. Those concerns that we saw here in the broader markets have only continued to be an issue here. So So what we're looking at here right now with regards to the markets here, growth continues to outperform value here. This is something that we continue to see at an extreme here at the moment. So this is something that we are going to continue monitoring. You see commodities actually show a little bit of strength here today. We saw commodities kind of hug the 50-day moving. Oops. We saw commodities hug the 50-day moving average, but yesterday's price action started to break out higher from that 50-day moving average. This is the first kind of constructive move we've seen from commodities here in the past couple of months. So this is something that we are starting to see, especially on oil, pushing higher here on the geopolitical tensions we've seen here out of the geopolitical tensions we've seen out of the Middle East is something that we are continuing to push oil higher here. And this is leading commodities to outperform the S&P 500 in the short run here at the moment. You look at corporate bonds, high yield bonds. We see high yield bonds trading back into this trading range. We were looking for that breakout here to kind of provide a risk on signal here from bonds, but that has not followed through and continued moving higher. It actually had started to drop back into this trading range. So if we look at bonds, not providing us also with a clear risk on signal here that I think a lot of investors might be looking for from equities. So looking at the VIX, we continue to see the VIX close at, yearly lows here. We're talking about 12% here. So participants not expecting a lot of volatility, not a lot of fear here in the markets. And as a result of that, this really kind of puts us in a volatility regime that's expecting low volatility. So even though volatility is low, we're in a regime where it kind of favors options selling here rather than options buying because of how suppressed volatility has been, which is counterintuitive. But that's kind of the regime that we continue to find ourselves in. If we look at the 10-year yield, we saw the 10-year yield climb again here into that 4.5% level here. We just touched that level yesterday. This is something to be aware of, the fact that 10-year yields continue to climb. And this is speaking to the fact that, and this is why equities are continuing to be pressured a little bit to the downside despite the inflation print. So kind of, I think this is the bond market repricing the optimism it had earlier this month with regards to expectations for rate cuts. We had that cooler than expected inflation print a couple of weeks ago. Bond markets got really excited about potentially seeing more than one rate cut for the year. And we're seeing a lot of that being pared back here at the moment as rates kind of continue to rise. And this is what's pressuring equities lower here, is the fact that rates are not lowering as expected. You see TLT, the bond ETF, that it looked like it was breaking out from this bearish trend line that has been in place for 6 months here, but now we've come all the way back to revisit this trend line here as support. We'll see if this bounces higher from here, but certainly bonds had its wind taken out of its sails here over the past couple of trading sessions. We have the dollar index continuing to stay above this 105 level here and potentially continuing higher here. So dollar continues to look fairly constructive here, especially as yields continue to rise. You have gold. Gold continues to trade below that 50-day moving average here, below 2,300. And what we were looking at is really just a potential continuation lower here to that 2,300. And if you look at that relative performance, this is really where the risk here is for gold to reach that 2,300 and potentially break down below it. You see the 50-day moving average already starting to slope lower here from here. So overall, this doesn't particularly look very constructive here for gold. On the flip side, for oil, this looks a lot more constructive here. We saw the breakout here above 80, has continued to break out from here, cross above the 50-day moving average, broke above 80, and now we're looking like we're about to continue onto that $88 level here to the upside. We've seen inventories come in relatively on the lighter side with oil, and we also have seen the geopolitical tensions here in the Middle East drive oil prices even higher from where we are. And then you look at the overall sectors. This is really where we have technology continue to be a pretty strong driver here of growth, but you see technology has lost some of that relative strength here over the past couple of weeks. And this is relatively healthy because, what we have seen is just technology has been the primary driver of returns of the S&P 500 over the past, 6 or 7 weeks or so. We needed to see a bit of sector rotation here where the strength from technology is not the only leader here in the equity markets. And we're seeing a little bit of that here last week. But we're starting to see strength here out of technology here again over this past week or so. So this is something that is concerning to us. We have seen discretionary show a little bit of strength here. It hasn't quite broken out above this 184 just yet. We can potentially see that, but when we look at some of the underlying names within this particular sector, it doesn't look that attractive. It doesn't look that encouraging. The overall trend here for consumer discretionary, as you can see, still remains pretty poor in terms of relative strength. We've seen communications show a bit of strength here, but overall we saw some of that strength lose over the past couple of weeks. We haven't made a new higher high in terms of that relative performance to the S&P 500. So the concerns that we saw here a few weeks ago that sort of looked like they were starting to reverse here last week, So far, at the beginning of this week, has not been particularly strong. It hasn't really continued, as you can see. Financials losing some strength here. Consumer staples continuing to lose strength. Um, Healthcare losing strength here. Uh, Materials losing further strength. Industrials losing further strength. So as you can see, you really have no sectors that are leading with the exception of technology. And that's not healthy for a market to only see one sector leading higher. You do have energy gaining a little bit here this week. We likely, in my opinion, will probably see the breakout above that 50-day moving average in XLE and continue higher. But that's really the only sector, as a result of oil prices gaining. But if you look at every other sector, utilities, defensive sectors, offensive sectors, all of them losing relative strength to the S&P 500. And when you see that poor of a lack of participation of the broader markets, it's hard to have confidence that markets can continue to move higher. You need to see these lagging sectors start catching up. And we started to see a little bit of that last week, and for the bulls, the hope was that that was going to continue, but so far this week that has not continued. It's the exact opposite has been happening. So that's kind of where we currently sit here at the moment. You look at home builders continuing to be poor here, starting to break below some major support levels here at 100. This was the major level that we're paying attention to, is whether 100 can hold. And just yesterday, that broke, and that has some severe ramifications for home builders. D.R. Horton, Lennar, Pulte Group. These are the ones that I think have some opportunities here to the downside. Semiconductors also losing that relative strength. NVIDIA has been leading the markets lower here. So overall, even some of the industries that have been leading the markets higher have not been performing. And that's really some of the biggest concerns that we have here with the broader markets. So looking at some ideas here for the week, let's pull up. So one I think worth paying attention to is Caterpillar. Um, so I think the level that we should pay attention to here is around that 340, 330 support resistance level. As you can see, this has been a major support and resistance level for the better part of, call it, 6 months. And multiple times we've kind of retested this level as resistance recently. And the question is whether this continues to move lower from here. And if you look at the relative performance of Caterpillar to its sector, it's quite poor. And then if you look at the fundamentals here, the growth expectations here for Caterpillar are pretty marginal. We're seeing about 7% EPS growth. Revenue growth is expected to be flat. It's got good margins, but remember, Caterpillar is a hardware type stock, meaning with these types of stocks, they don't typically trade at very high multiples. So it trades at about 15 times forward earnings, which is on the higher end of its valuation range. Especially as industrial stocks like Caterpillar, try to, pitch themselves as a technology company, but investors are just not buying it. So trading at 15 times forward earnings is still relatively expensive from a valuation perspective for these types of industrial stocks. So given the fact that growth expectations are fairly tepid, I think that trading at 15 times forward earnings, the fundamentals here for Caterpillar do not look that strong. Another one I want to take a look at here is Salesforce. We took a bearish position here in Salesforce recently prior to this earnings, and when it broke down below this 265 level all the way down to 215 on earnings, that was a good bearish trade. But now we've actually managed to climb all the way back up almost to the gap fill, but we're not quite there yet. And that's really kind of where I think the risk to reward favors further downside. When we look at Caterpillar here, Salesforce. It trades at 26 times forward earnings. Now, Salesforce is expected to grow at a pretty healthy clip, EPS growth of about 16%, which is quite a bit higher than the average S&P 500 stock. But remember, it does trade at a 25% premium to the average S&P 500 stock from a valuation perspective. So, 16% EPS growth may sound impressive, but you have to remember this is a stock that was growing at 45% EPS growth just a couple of years ago. We're talking about growth that's kind of lost 2/3 of its growth in the past couple of years. So I think for Salesforce to continue to trade at these relatively significant premiums relative to the S&P 500 is a risk for investors, and that's why I think the fundamentals here align fairly well here with the technicals. DHI, DR Horton. This is the home builder that I was referring to. We saw XHB, the home builder ETF, break below that major $100 support level, and we actually see DR Horton also breaking below 140, which is a pretty significant support level here for DR Horton. That it's been in this topping formation since December of last year, and it looks like this topping formation is potentially starting to break down. You have a gap fill down here at 122.5. That would be kind of a potential initial target here to the downside on DR Horton. Another one is AstraZeneca. AstraZeneca recently broke out from the $70 level here to the upside. And it's pulled back a couple of times, that were kind of buying opportunities. And this is kind of what we're looking at as a potential buying opportunity here on a continuation higher here for this bullish trend. Trades at about 18 times forward earnings, which is about a 10% discount relative to the S&P 500 to 10-12%. And it's expected to grow at a pretty healthy clip, about a 12% EPS growth. Revenue growth is expected to grow at about 8%. So you're looking at a decent amount of growth. And it trades at a decent discount relative to the S&P 500. So this is really where the technicals kind of align fairly well here with the fundamentals. Another one is Adobe. We continue to like Adobe, but we are very close to its target price here, which is 570. That's the gap that we're looking for it to fill. We've been long Adobe pretty much since it was in the 460s or so, expecting this to kind of pop higher here, and that's exactly what we did. And we're looking for it to close that gap into the 570. So we're very, very close to that target price. This is one that we've been talking about for multiple weeks. So for those of you that have been following us and been able to take that trade, just wanted to give you an update that we're very close to the target price here of 570 on Adobe. And last one here, Quanta Power. This is one that is starting to break down here as well. However you want to draw your lines. This is a stock that recently broke below kind of a major support level here. You can also draw your lines this way, breaking down below some major support levels around this 265 level. That breakdown, I think, is significant because this is a stock that trades at 30 times forward earnings. Now, growth is decent, right? 15% EPS growth, revenue growth, that's about 11%. That's significantly less than, what some software type companies that are trading, even at lower multiples than this one is trading at. This is trading at 30 times forward earnings. That's 50% premium to the average S&P 500 stock. Now, granted, it's growing at a healthy clip, but certainly not at a rate that I think justifies a 50% premium relative to the S&P 500. And I think the nail on the coffin here for Quanta Powers is the fact that their net margins are so thin. We're talking about 3.5% net margins. That means for every $1 they make in revenue, they only earn 3.5 cents in net income. So we're talking about razor thin margins that a ton of risk to the downside, if they miss on earnings. And that's really where I think the fact that this stock trades at 30 times forward earnings is just outright ridiculous. And when you look at the technical picture, it aligns with some potential downside. And if you look at the fundamentals, it just trades at valuations that I think are absolutely crazy. which is why it's one of our bearish opportunities here at the moment. So with that, that covers what I wanted to share with you here today. I hope that this gives you a better understanding of how we're currently viewing the macro picture. Overall, it doesn't look particularly strong here for bulls. Certainly a lot of risk here to the downside for bears to take advantage. Looking at the chart, certainly seems to be quite a few bearish potential setups here. Stocks that are overvalued where the technical picture is starting to look weak. We're seeing a lot of those here at the moment. So that's kind of how we're viewing this markets. I hope this is helpful in giving you a better understanding of how we're viewing it. And thank you so much, and I'll see you guys here next week.